Good morning, everyone. This is Curtis Hawks over at Insurance Agency Marketing Services, and I want to thank you for joining us on the call today. We've got a really, I think, exciting topic, and one of the reasons for that is, we do a lot of business in the accumulation life space, but, if you look at the last couple of years, there hasn't been a ton of innovation, and so we're really excited about new product offering, and so we'll do a deep dive into that today. Before getting into the main event, I did want to take a couple of minutes to chat a little bit about some of the additional ways IAMS is here to add value to your business. So first up, we've got our new producer builders. And as you can see up there, we've got a number of different point totals from 100,000 to 1 million. And in your first 6 months with us, you automatically get enrolled into our new producer bonus program. You can see there's a variety of different options up there that you could cash out at, whether it's marketing programs, marketing dollars, cash, trips, etc. And if you've got questions on that and like to know a little bit more, just reach out and talk to a sales director over here. That number is 800-255-5055. In addition to that, we've got a referred producer program. If you know of an agent who maybe isn't quite happy with their current IMO relationship or you think might be a good fit over here, send them our way. Not only will you get a bonus when they first get contracted, but then on an ongoing basis, you'll receive bonus based off of their production. You don't have to do anything. We'll take care of all the service and support for the agent, but it can be a great way to generate an additional revenue stream for you. In addition to that, we've got our standard marketing reimbursement program. As you can see, that's $100 for every qualifying 100,000 of indexed annuity premium. And then on the life insurance side, it's $200 for every 100,000 of single premium life and $200 for every 10,000 of life target. And if you'd like to know more about that, just reach out and talk to a sales director over here. That number is 800-255-5055. Back office support, I'll touch on this. It's been a cornerstone of IAMS for the last 38 years, but whether it's pre-sale, illustrations, design work, pre-underwriting, those types of things, to the submission to commission process, the team does an amazing job over here. And so if you haven't tested us out on that, I would definitely encourage you to do so. We also have our IAMS portal. This is a wealth of resources. You do need to be contracted to access this, so if you're not, reach out, talk to a sales director over here. That number is 800-255-5055. But we've got quoting software on there for annuities and life insurance. We've got current rates. In addition to that, we've got our EAP platforms, product information, underwriting information. We also have our sales resource library, which literally has hundreds of point-of-sale pieces right there that you can instantly download on just about any topic you could think of talking to a consumer about. And so if you've got questions on getting access to that, reach out, talk to a sales director over here. That number is 800-255-5055. In addition to that, as I mentioned, we do integrate with all of the standard EAP platforms, so Firelight, iPipeline, as well as Sunfire on the Medicare side. And if you're curious about what carriers integrate where, we do have some cheat sheets. I'll pull up an example here. And you just reach out, talk to a sales director, and they can get that over to you. Again, that number is 800-255-5055. In addition to that, we've got our creative marketing team, and creative really is the key word. They work on a variety of projects for a number of agents all over the country that are at different phases of their career, but they do just an excellent job when it comes to taking an idea that you might have and bringing that to fruition. They also have a very big focus on brand. Brand and branding has really evolved over the last few years, and it's really, when you look at the marketplace, is placed a greater importance on your digital brand. We have more and more agents who are doing virtual sales and consumers who are doing more research online. And so if you don't have a robust digital brand in addition to your local marketplace, it definitely can impact your business. And so if you've got questions on those services and how you get access to it, just reach out, talk to a sales director over here. Again, the number is 800-255-5055. In addition to that, we did launch an RIA several years ago. We've seen significant growth with IAMS Wealth Management. I'm going to go ahead and launch our first poll of the day. if you've been thinking about adding AUM to your business, or have, maybe you've got your 65 currently and just aren't quite happy with the current RIA relationship, just check yes there. We'll have somebody from IAMS reach out to you and chat with you a little bit about some of the services that they provide. Next up, we've got our Life and Annuity Academy. In fact, we've got one of those this week. And, these events really are an amazing opportunity for you to spend some time working on your business. It's not easy to do that when you're out in the field and you're running your business, you're meeting with prospects, clients, dealing with the IMOs, carriers, etc. But our Life and Annuity Academies really are an amazing opportunity to spend some time working on your business. I'll go ahead and launch our second poll, but you will walk away with being in the know on what are the most current annuity and life insurance trends, what are the most cutting-edge marketing strategies that are out there, as well as a wealth of knowledge on competitive products, sales ideas. We bring in top producers to present as well to talk about best practices in their business and what's created success for them, as well as what are the most cutting-edge software platforms that are out there that you should be incorporating into your business. And so what you'll walk away with is not only a wealth of ideas from a long-term standpoint, but also ideas that you can go back and immediately implement into your practice that can make a dramatic impact. And so if you've got interest in attending one of our upcoming Life and Annuity Academies, just check yes in the box. These fill up relatively quickly, and so I can have a sales director reach out to you about that. So we'll go ahead and get this closed down here. Lastly, make sure to follow and like us on Facebook and LinkedIn. We syndicate a lot of content, whether it's on product changes and rates, marketing ideas, what's going on in the industry, and this is one of the best ways to see that information. So with that, I'm going to go ahead and get our presenter on here. And we've got Krista Johnson with Allianz Life with us today. She's been an amazing resource for us over the years. And as I mentioned, there hasn't been a ton of innovation, a ton of updates in the IUL space for the last couple of years. And so it's really exciting to see Allianz roll out a new, as competitive as a Life Pro Plus was, an even more competitive product. And so she's going to give us a deep dive on their new offering and how you can incorporate this into your practice. So Krista, appreciate you taking some time with us today. Oh, can't hear you.
I learned how to share my screen, turn my camera on, but I forgot to unmute myself. Sorry about that. So thank you so much for taking time to join us today. My name is Krista Johnson, and actually let me switch the screen here. All right, so my name is Krista Johnson. I am a senior divisional sales consultant with Allianz in life distribution. Next month, I am celebrating my 20th year with the company. 15 of those years has been on the life insurance side of the business. So I've really seen a lot of the evolution of the different products that we're offering, and then really excited to share this brand new product with you today. So I'm going to turn my camera off now. Sitting in a hotel room here in LA. So just wanted to introduce myself there quickly to you all. All right, so let's jump into the product, and then I would love it if there's any questions, if you guys can type those into the chat. And then Curtis, I'll pause every now and then and see if there's anything that we can address as we go through this presentation. All right, these first couple of slides really are, okay, great. First couple of slides are really just kind of the compliance slides. You know, it's a life insurance product that offers living benefits, cash accumulation, access to the cash value via policy loans or withdrawals. Allianz has always been very flexible in how in the different loan opportunities. So that hasn't changed with this new product at all. So it's the same as what you might already be used to. This again is another compliance type of slide. The bottom two, again, options for accessing money is important with that loan flexibility, all the different features that we offer there. And then also our index lock. So those bottom two bullets there, I think are huge highlights to not only the products in the past, but the product of the future called the Life Accumulator. So let's get more into what's new, what's changing, and what makes this product different than our last product. All right, so this product actually just launched last Tuesday, the 16th, and we retired our last series of products, which was the Life Pro Plus. So it started with the Life Pro Plus. We also had the Life Pro Plus Elite and the Life Pro Plus Advantage over a 13-year period. So we finally retired that brand and now have this brand new product called the Life Accumulator. One thing to note is that on that last product, we also had different versions throughout those different series. So, you know, we had version 1, version 2, you know, all the way up to like version 7. So now in the name of this product, we have incorporated the ability to have it be Life Accumulator IUL 1.0, 2.0, 3.0. The reason I bring that up is because that's going to be a lot easier for you and your clients to understand which version of the product that they have, because, you know, with Allianz being an innovator, we're always adding updates, new enhancements, new features, new indexes, and that sort of thing. So you're always going to know what version you have. And from an in-force management perspective, that's also going to make it a lot easier on our in-force business team as well. So just wanted to point that out, that is also something that's changing. Pricing adjustments. So just kind of going down the bullets here. We've got new premium loads. So the premium load has changed, and I've got a slide coming up to talk to you about that. The target premiums at older ages. So we knew back in 2021 when we, you know, when the interest rate assumptions changed due to 7702, we wanted to keep our target premium at the same level it was prior to 7702, so that it didn't come at the expense of compensation to our agents, even with lower death benefits. So we did that, and what we saw is that our target premiums were much, much higher, especially at the older ages. We were way outside the industry standards. It has been that way for quite a while. And what that meant for those older ages is that we weren't as competitive because we were paying more in target and commission. The internal workings of the product at those older ages was not as competitive. So what we've done is we've come back a little bit more to the industry standard. You're going to see slightly lower target premiums at 60 plus, and also more competitive when it comes to cash accumulation and the loans. And I think that's obviously what's really important when you're selling at these older ages to those clients. They're looking at it for income perspective and also for accumulation. So that's going to make us a lot more competitive. One other thing that we were able to do because of the interest rate environment that we're in and the higher yield that we're seeing is we were able to bump up our classic bonus. Prior to the 16th, so last Monday, our classic bonus was 0.90%, so 90 basis points. So we were able to go up to 100 basis points or 1%, a little bit easier to talk about. You know, now you can say we truly do have a 1% floor when you have the classic bonus. So we're excited about that change on our illustrations and really just making our product look a little bit more competitive on illustrations as well. So the next one is our premium deposit fund rider. So our PDF increased from 5% up to 6%. So we've got, and this is for new premium deposit funds, so single premiums that go into the policy to help fund it over a 3 to 10 year period is how long the PDF pays out for. It's increased to 6%. It is the highest in the industry. So a really good option for those clients that have a lump sum. Maybe they want to hand it over to you and say, hey, I would really love to earmark this for my life insurance policy right now. I want it to grow cash accumulation. Well, they're also going to get a 6% premium discount on that. So more premium going into the policy working for them day one. So that is a great increase as well. Now, the new index options. So we're going to spend quite a bit of time on these new index options just to kind of go through them, let you know what they're made up of, volatility control or not volatility control, and all of that. But the first one on this list is the blended. Well, we've got new indexes. One of them is the blended futures ER, and the second one is the S&P 500 futures index. The S&P 500 futures index is getting a lot of buzz. It's equity only. It's looking at the futures of the S&P 500. I've got a slide coming up that kind of puts this side by side with the actual S&P 500 index. I think you're going to like what you see, and I think it's going to be a great option for your clients as part of the allocation mix that they put onto their policies as well. Both of these are lockable for index lock, and they do include all the different bonus options that we offer. I've got a slide coming up, so I'll get to more of these in just a minute. We also replace, so we have what we call the BUDB, but the Bloomberg US Dynamic Balance 2 index is being replaced by the number 3 ER index. So I'll give you a little comparison of those in just a moment. One thing to note on those is the Bloomberg. So what we've done is we took the BUDB 2, which was the original one, or the one that we had as of last Monday, which had a equity and a bond component in it, and it would, it has an internal algorithm that would shift between equities and bonds depending on the market volatility. What we've done is we've introduced the 3 index, which now is going to be equity only. So it's equity only. It does not have a bond component because, let's face it, over the last couple years, there has been kind of a lack of performance in our BUDB 2 because of the unprecedented bond volatility in the market. So we've kind of erased that and brought out this new Bloomberg US Dynamic Balance 3 index that does not have a bond component in it. So I'll go into that and just show you a slide on what that looks like as well. Another thing that's changing is the index lock lower threshold. So on our index lock prior to last Tuesday, so we had you could set an upper target. So let's say you sell a policy to a client. The client starts day 1 at whatever index allocations they have. If they have any of the index lock or allocation options, they have the ability of setting a higher target, meaning that they could set it at 14, 15, 20%. If the index value ever gets to that point, it would automatically lock in so that they don't have to worry about volatility for the rest of their policy year. It locks it in at the end of that policy year. We would then credit their accumulation value with that index value credit. Now we have what's called a lower threshold, and that lower threshold for the index lock is wonderful. So as that index is climbing, maybe they're getting up close to whatever they set their higher threshold at. Maybe they set an upper target at 14, and it's getting up. They see their index value getting up to 10, 11, 12%. So it's getting close to that 14. But what they can actually do is now they can go in and set a lower target or a lower threshold on the website. Either you, the agent, or the client can go in and set that lower threshold. Maybe they want to set that at 10, 11, 12, and maybe 2 points below where the index value is currently at, so that it's kind of like a stop loss, meaning if the market does start to go down, it's never going to go below that. It would lock in at that lower threshold. So they can continue to maneuver this. If they see it getting close to that upper threshold, maybe they want to move that target up a little bit higher, and at the same time then move that upper or that lower threshold as well. So again, upping that the stop loss on it as so that they're not going below that lower threshold. This is really a unique feature. Again, index lock is a unique feature, but adding that lower threshold, our annuity side of the business already had that in there. So it's new to the life insurance side. So we're super excited about that. And the other thing that's really exciting is that we didn't just put this on this new product. When we turned that lower threshold option on, it goes to all of our Life Pro Plus products going all the way back to 2011. So if you've already sold a policy, you've got policies in force with us, You are going to also have that index lock lower threshold available right now. So if you were to log into the policy on the website, you would now see that as an option. So that's definitely an option for you to contact your client and let them know about this new feature, and maybe look and see where their their index values are at. Maybe they want to set a target, or an upper target, and also a lower threshold at the same time. All right, and the last bullet here is the risk class upgrade program. So the risk class upgrade program is where a client, if you submit an application and the client is at standard or preferred, they're automatically going to get upgraded to preferred plus. All right, so we are extending that through the end of the third quarter. So we're in that third quarter right now. The last day to get an application in to possibly have that potential of getting upgraded to preferred plus, to the best risk class, is September 30th. So we would need the application in-house by September 30th. As long as it comes in by end of day September 30th, they are still going to be eligible for that upgrade. This program is actually coming up on its 2-year anniversary. We launched this back in October of 2022. So we've fully intended to put this out there as a promotion, if you will, and we've been able to continue that promotion because we hadn't had a new product. So now that we have this new product, we do have to have an end date to the promotion, but we are allowing the accumulator to take part in it up until September 30th. So if you've got anyone on the fence, that possibly could just get a standard risk class, you might want to try to get that application in now before September 30th so they can take advantage of the promotion. All right, so that is the scope of the changes. One other small change to the product that is not listed here because it's not widely used is the child term rider is not on this product. It was on our last product. It is not available on this product. That child term rider allowed for 1 child or 10 children, however many your clients had, to be put on as a term rider, anywhere between $5,000 and $10,000. We had less than a 1% utilization on that particular rider, so I don't think anyone's going to miss it. And really, the term rider is child term riders. You see those more on term products, so we were kind of out of the standard industry norm, if you will, by having that on our last product. So I do want to mention that has been removed. All right. So first of all, on one of those bullets was the premium loads. So the premium loads on the product, now it does say current and proposed. Current, it was our last product actually. So the last Life Pro Plus Advantage, the premium load was 8% years 1 through 9, and then 4% years 10 and on. All right. And then also for supplemental premium, we also had a 14% supplemental premium load, if you will, above what's called the MEC limits. Think of this as, when there were large 1035s coming in, or any 1035s, it was that 1035 was coming in, and that was above the target and the modified endowment contract levels. And so that 1035 was actually getting a 14% premium charge year 1. What we're doing now, or with this new product, we've got a 9%, it's 9% year 1. So 1% higher than the last one, but we do not have the supplemental premium load. That has gone away. Interest rates obviously has changed since we introduced that premium load, and so we do not need to have any profitability at all with those premium loads at this point. So it's 9% year 1, 5% years 2 and on. And 2 and on, and however long they're paying the premium into the policy as well. This is really allowing us to, again, have more competitiveness on the illustration. It's lowering the charges overall, and so you're going to see higher accumulation, higher income at almost every age. There might be 1 or 2 cells at different ages where it's similar, or maybe it doesn't look as great, but from all the different, and I only say that because you might find one. We were unable to find any of those cells at this point when we were doing our benchmarking. that the new product did not look better than the old product. And again, this is one of the reasons why, is because the premium loans have changed significantly. This next slide that I'll show you actually just puts it, gives you a visual of how that looks. I know the colors are a little goofy here, but you can see that the first product, the Life Pro Plus, on the first line here, shows that 8% every year through, or the 9 years of 8%, and then dropping down to 4%, and then it's got the cumulative total charges in the yellow. The new accumulator IUL, same thing. We've got the 9% year one, and then 5% every year after. And you can really see that, you know, if you're looking at short pay, obviously 5-year, 10-year, 15-year, 20-year, you're looking at charges that are overall on premium loads at least a lot lower than the last product. So again, this is just going to enhance the competitiveness of the product. All right, so these are, again, some of those different changes. We talked about the target premiums at the older ages. Again, this was just because we were outside the industry standard after changing the interest rate assumptions back in 2021 because of 7702. And then we've got the bonus increasing to 1%. Because we're increasing the bonus to 1%, AG 49 guidelines indicate to us that we had to actually bring our max illustrated rate down for our classic bonus down to 6.72 versus the 6.74. So right now our default illustration is going to be at those classic bonus options, and you will see a max illustrated rate of 6.72. The good news is that running that 6.72 with the 100 basis point or the 1% classic bonus brings that up to 772 versus the old one at 6.74 with the 90 bips. So it actually is still, even though we're running it just at 6.72, it is still going to show a lot more competitive on the illustration. And again, we talked about the PDF rate increasing to 6% rather than the 5%. All right, so let's get into the different index allocations, because I think this is really, you know, where some of the excitement is coming from. So the new indexes are listed here. So we'll start right off with the one that's getting the most buzz and the most attention from, you know, a lot of our marketers and a lot of the agents. In fact, last week we did a webinar, kind of a launch webinar last Wednesday, so a week ago today. And it was the largest attended webinar in the history of our life insurance side of the business. We had over 900 attendees on that webinar. So we got a lot of feedback from the agents that were on that when we launched this product, just a lot of excitement about what's happening with this index as well. So this is called the S&P 500 Futures Index ER. So ER, just for those of you who either new with us or maybe haven't done a lot of volatility controlled indexes, it means excess returns. So we're tracking the futures of the S&P 500. And one thing to note, this is not a volatility controlled index. So there in this particular index, there is no internal algorithm telling us to shift between the equities and a bond component. This is equity only. There is no bond component. And you can see there the bullet says it's tracking the 3-month S&P 500 futures. What is the future price? What is the future S&P 500 going to be priced at? That's what it's tracking. The Bloomberg US Dynamic Balance 3 ER index, this is a volatility controlled index, but it does not have a bond component like our last Budbee or Bloomberg index did. So no bond component. Instead, there is going to be a cash component available when there is extreme volatility. So we can always pull back a portion of the cash in this policy and put it into the cash component when basically for protection. There is no yield on it. It's really just protecting where those dollars are allocated. So you can see that the Bloomberg 3 index is made up of 80% large cap, 10% small cap, and 10% tech. So it is diversified within it. It just does not have the bond component. And therefore, you know, when bond prices are not good and when there's volatility in it, there's not going to be that little bit of a drag from a bond component like we're seeing, or that we've seen recently with our BUD B2. The next index is our blended futures index. This again is not a volatility controlled index, okay? But it does have, similar to the blended index that we had on our last product, it has a mix of different components within it. This does contain a 60-40 mix of 60 equity, 40% bond. And you can see what it's made up of right there. So we do have our Bloomberg US, well, the Bloomberg bonds, it's tracking the US 10-year note, custom futures ER index. I'll just read that out, but you can read that as well. Equity component. So the equity component is similar to the last one where we had the mix. We had a large cap, we had a small cap, and then we also had an international cap. This has the same thing. You can see what it's made up of there. These do not change. They are static, just like the blended index. Now, all three of these on this page are lockable indexes, like you can see there, which means they all have a participation rate and they are uncapped. So that is what allows us to have these added on to the index lock and the lockable features. I'm going to get into each one of these and I'm going to show you, how they look in comparison to the actual S&P 500, and then also how these other two compare to the old versions that we had on the product. But I'm going to pause here for a second and ask Curtis, are there any questions or anything coming up in the chat?
Yeah, a couple of questions was how long is the 6% guaranteed for on the premium deposit account?
Yeah, the 6%, contractually, it is not guaranteed. So once you purchase the policy, it is guaranteed contractually for at least 1 year or your policy year. What I can tell you is that we have never ever changed the premium deposit fund rider. The reason that we most likely will never change that on an in-force contract is because, think about it, if we were to change that 6%, let's say somebody is max funding their life insurance policy, they've got the minimum death benefit and they're max funding it with that premium deposit fund rate. If we were to increase that 6%, it would then most likely cause that policy to MEC. On the flip side, if a person was minimally funding, maybe they had, the max death benefit, they were solving for the max death benefit for the amount of lump sum premium they were putting into it. The opposite would be true. If we were to lower the premium deposit fund rider rate, that could potentially cause that policy to lapse. So what I can tell you is contractually we have the ability to change it if we wanted to, but for all of these different reasons that I just said, we will most likely never ever change an in-force policy. Where we will make changes is to new business coming in. So you could see that 6% change, but I think with the environment that we're in right now, the interest rate environment and the market, and where this policy was priced, I think that 6% is here to stay on the new business as well, and hopefully will last until we come out with a new version of the product, which could be years from now. Hopefully that helps alleviate any concerns there. What else is coming up?
Do you guys still have PIMCO as an index?
Yes, we do. So yes, we still have the S&P 500, just the standard index with 3 different crediting methods. And I've got a slide coming up that's going to show that. And then we still have the PIMCO as well. The PIMCO is doing great. It has been doing great over the last few years. That one was really designed for a rising interest rate environment, which we've been in. And so you've seen a lot, lots of double-digit returns coming in on the PIMCO over the last several years. So yes, we have not changed that. That is still available on the policy also.
Okay. And then we've got another question on what par rates are. I'm guessing that we've got a slide coming up on that, so maybe we don't address that right now.
Yep.
And then the last question we have before we move on is, it seems like you guys are maybe having a little bit bigger focus on large cap. What's the reasoning for that?
I think it's just where the equity focus is as well. I mean, if you think of the S&P 500, kind of the same thing, and then the Bloomberg, we don't design the Bloomberg. We actually Bloomberg already has this index available, so you can see that there's a ticker symbol. You can watch it. That's just where their mix is already allocated to. So we didn't design this particular index. We just adopted it, and it's already out there available.
Okay, perfect. I think that's all the questions that we have at this point.
Okay, we'll pause again here in just a minute as soon as I start going through the different options, anticipating that we might have a few more. Okay, let me see. There we go. Okay, so here is, this slide looks a little busy, and I apologize for that. I didn't create this particular slide, but this is just showing all the different allocation options. So you just asked about PIMCO. Yes, that's there. You asked about S&P. That's still there too. So the benchmark index is the S&P 500. That's how we decide, how we're going to, or how we are able to offer our max illustrated rate. So every carrier you're going to see is going to have a standard S&P 500. We still have that. One thing that we do have also is the different crediting methods. So if you look down that first column at the S&P 500, we still have the monthly sum, the annual point-to-point with the cap. So those are both capped. And then also our trigger. So the performance trigger is still there as well. That trigger is, for those of you who might not know, is when the S&P is up or flat at 0 or any positive movement at all in the S&P, it's going to automatically lock in a specific trigger rate. And so that might be good, maybe during the loan phases or something like that. So we didn't remove any of those different crediting methods that are available with S&P. Where we really want to focus is all of these, the next 4. So we've got the S&P 500 futures, we've got the blended futures index, the Bloomberg US Dynamics Balance 3 index, which we've talked quite a bit about, and then also the PIMCO Tactical Balance Index. That has not changed whatsoever. So we've got 2 indexes that offer a blend of bond and equity. That's going to be that blended and the PIMCO. And then now we've got straight equity focused, which is the S&P 500 and the Bloomberg. The 4 here are all considered lockable, and they also have all 3 bonus options. So when you look at these last 4 indexes, there's actually 12 opportunities. So there's 12 allocation options when you include, the 4 different indexes with the 3 different bonus opportunities. So 12 different possible lockable combinations if you want to be confused and have your clients confused. Otherwise, they can pick and choose any one of these as well. What we're thinking is, now that we have the S&P 500 futures, we already had very low usage of our standard benchmark S&P 500. I would say probably maybe 5 to 7% of all allocated options go into the standard S&P, and the rest of them were going into our volatility controlled indexes, which at that point were the BUDB2 and the PIMCO. Now that we've got these other options, I think we're going to see even less going into that standard S&P, because I think people are really going to like the uncapped version of the S&P 500 futures, and then some of these other options as well. So I think we're going to see a shift again in how people are allocating onto our product. One other thing to mention too is the S&P 500 standard is not a lockable option. I just saw that blue mark here as I was trying to turn the page. So that's the only index option index that we offer that does not have the index lock feature attached to it. All right. So here is where all the excitement is coming up on this S&P 500 futures. So this graph actually shows, or this chart shows that how it tracks according to the S&P 500. So you've got the pink, which is the futures ER index, and you've got the blue line, which is the S&P 500. In any of the last 10 years that we were tracking, there was really only a max of about 1 to 2% in difference in their values. And so I think this one is going to be, again, really exciting and heavily used as far as trackable, because people were wanting that equities component. They were wanting to have a 100% equities component. They wanted the S&P 500, but now we've got an S&P 500 futures ER, which has an 80% participation rate, which you can see at the top. That's with our classic bonus, versus the S&P 500 annual point-to-point, which we currently have one of the highest caps in the industry at 12.5%. It's not the highest, but it is one of the highest out there. So when you compare those and track the movement of that with that 80% participation rate, you can see that overall the average over the last 20 years has been 11.17 versus 8.15. Now the S&P 500 futures is going to act like you can see here that it acts very similarly to the S&P 500, which means, you know, you're going to have home runs, you're going to have double-digit returns. You're also going to hit a zero about every 4th year on the product or on the index. So that doesn't change at all. And you can see over on the right-hand side on this list, you see about every 4 years you're hitting a zero. So that is definitely going to happen, but you want to have something that's going to be able to offset that, maybe in those double digits and the higher double digits, something higher than even just the cap 12.5% bonus. You can see that happening. So when the market is kind of on the lower side, you know, then the annual point-to-point cap might be a better option. But overall, you're seeing in those years when the S&P is capping out, you're able to get a lot more returns with that 80% participation rate and no cap on that S&P 500 futures ER. All right, so that is a look at this one. We do have a great marketing piece that's got this chart built into it as well. Our new index allocation guide has this particular piece and information and the historical information in it also. So these are great pieces that are not only for you, but also for your clients, if you're talking about some of these different indexes and sharing with them how they perform. The blended futures, now this is comparing it to our last blended index that was made up of a little bit different mix. The mix on the last one was 35% Bloomberg bond, 35% Dow Jones, 20% small caps, 10% Euro. So the mix is a little bit different. Remember, this one is now a 60-40 blend on the new one. But again, overall, the last blended index, it had the classic bonus, but it was capped out at 8.75. That became a very expensive option to price. So we've shifted over to this blended futures ER index, a little bit more reliable and stable when it comes to pricing as well. So you should see more steady participation rates on this one. And you can see that the average over time, being uncapped and with the 20% participation rate, you're looking at 10.77 versus 6.35. So a real big improvement here as well. Again, going to look a little bit more competitive overall in the long run versus just that capped option. All right, so this one, the Bloomberg 3. So if you look at the bottom, you can see that they're pretty close, right? They're almost the same, 10.4 on the Bloomberg 2 versus 10.12 on the current one. But what we really wanted to do is we wanted to introduce this one that was made up something different, because over the last several years, the feedback that we've gotten is that, hey, you know, Allianz, the market's doing great. The S&P is up, you know, 20%. What's going on with the BUDB and the Bloomberg and this allocation that is returning, you know, either zero in 2022. I think everything was zero in 2022, but 2023, you know, when the market was going up like gangbusters, why is it only averaging the 5.05? Actually, there were some dates that had zeros. There were some that had 10. So again, you're averaging at 505. And so we really wanted to address that at this point and then introduce this new one that does not have any bond component whatsoever. So again, there is no drag on the bond side when there's bond volatility. So I think we're going to see, you know, these kind of mirror each other, if you will. It's just that now we're looking at what today's environment is, and so that's why we went ahead and introduced this. They both have the same participation rate at 195%. And for those clients or for your policies that you sold already, they have that Bud B2, and we're actually seeing, that the bond prices start to normalize a little bit. There's a little bit less volatility. Who knows what's going to happen with the election coming up? But we are seeing some double-digit returns start to happen again on the Bud B, specifically with October and November start dates. So if you have any of those out there, take a look. Those could be getting close to 8, 9, 10% on the Bud B2 for that index lock value. So something to keep in mind. I've got one more. Oh, no, that was the last slide when it comes to the indexes. Are there any other questions? Anything to address there, Curtis?
So a couple of questions. On these new indices, are all of these going to be available on the Life Pro Plus products, or still with the indexes where that they already have on there?
That's a really good question, and that is definitely a question we've been getting since this product has launched. The answer is not yet. All right, so all the products, the Life Pro Plus products, series of products, they have many different index options, and right now what we're doing is these new index options are available only on the accumulator. In the past, Allianz has always been really good with our in-force book of business and adding all the features like the index lock, like the volatility controlled indexes that we had added on as well. So I can see, that potentially we will add these to those old blocks of business or in the future, but we just don't have the, we're not looking at doing it immediately. And here's the reason why. Because if we look back over all those different versions of the Life Pro Plus policy that we've sold since 2011, each version had different indexes. Okay, when we file with the state, we can add index options and crediting methods. We cannot remove any. So think of those clients back in, one of the versions of the product, maybe the Life Pro Plus Elite, they have some other options that are no longer available. Plus they have the new Bud B and, the version 1 and version 2 already. So they might already have 18 to 20 different allocation options available. And if we were to add these 4, that would just add more confusion. So we're looking to see, what is the experience of our in-force book of business versus the new book, and it's potential that we could add them in the future. But again, the answer is no, not at this moment. It is potentially going to happen in the future, though.
Okay. And then we had a question about what is the fixed interest option?
Yep. Fixed interest option is always available. Our fixed interest currently is 5.4%. Again, that's one of the highest in the industry as well when it comes to the fixed interest bucket.
Okay. And then looks like one more question. Can you elaborate on the E-mini S&P 500 futures and the role of the index and the mirror performance?
Okay, hold on. Can you repeat that one more time?
Sure. It says, can you elaborate on the E-mini S&P 500 futures and the role of the index and the mirror performance? So it sounds like kind of I think maybe how this mirrors. And if we can't get to that one, that's fine. I can have one of the markers reach out to the agent on it.
Okay, perfect. Yeah, you know what? I just brought it back to the slide. Just looking at the hypothetical historical returns. It says hypothetical because we didn't have this index option available on our products going back to January of 2003. But really, this is just looking at it over that 10-year period. Where did it track? And in any one of the years where you see that pink line differ from the blue, I mean, it's about a 1 to 2% difference in what the S&P 500 did over that same period. So it tracks and mirrors it almost identically. And then now, instead of having just the S&P 500 with a cap at 12.5%, now you have the opportunity of having that 80% uncapped option, which is also a lockable option in it. So I'm just kind of covering, I guess, what I had said before. If that's not answering your question, maybe, reach out to the marketer at IAMS for more information, and then also go onto our website and maybe pull up this particular piece, or I can get this over to you, Curtis, too, and you can share this with the attendees. But that will have a little more information about this, and then also the historical look at it also.
Perfect.
All right. Index lock. We've talked about that. Unique in the industry. We are the only carrier that has this particular option. And now we have the upper and the lower target threshold that you can set. Here are the different, again, the lineups. This is the 4 different lockable indexes that we have. Just kind of telling you a little bit more about them, that whether you want volatility control, where you want it to balance between bonds and equity components, or whether you want more of that static 100% S&P 500 futures, or the blended futures that does not, it's static and doesn't change. There's no volatility control in that whatsoever. All of these are the 4 that also have the different bonus opportunities. The bonus opportunities on our product are the classic bonus, which is the now 1% added on to the index credit at the end of the year. We have a 15% multiplier, which we call the bonus. It's bonused at 15%. And then we also have our select index option, which is a 40% bonus with a 1% asset charge. All of those bonuses plus that 1% asset charge on the select bonus are 100% guaranteed contractually for the life of the contract. Those cannot change. I do like to point that out because there are other carriers that offer bonuses that they have the ability of changing those. We can't change those on any of our policies contractually. All right, so with all of those different opportunities for your client, all those different allocation options, we've got the 15 different allocation options and crediting methods. If we look at that, the 4 different indices that we offer, or the 5, I'm sorry, with S&P 500 being the 5th one, plus a fixed interest account, we've got 15 different allocation options. So we wanted to make it a little bit easier for you when you're running these illustrations, for your clients, when they're looking at an illustration. We've built into the software 6 diversified strategies. And so we're really talking about diversification because we did some analysis on our last book of business, or the Life Pro Plus Advantage. And what we found is that, I'm sorry, not just the Life Pro Plus Advantage, but all the Life Pro Plus policies. We found that if somebody, if we went through every single policy and picked the very best allocation that had the best return in any one given year, the average over the last 13 years would have been, I think it was 13 years, or it could have been just the 11 years that the policy was in, but it would have been over 18%. But that person would have had to switch their allocations one by one, or a mix of them every single year. Plus they would have had to go into the fixed interest account 3 or 4 times to be able to get that 18%. And no one's ever going to be able to do that. None of us have a crystal ball. So we want to make sure that diversification is still an important feature on the product. With so many allocation options, it gives that client the ability to have some returns and avoid some zeros. All right, so we've got so pay attention to the left-hand side of the screen first, where it says conservative, moderate, or aggressive. So the conservative strategy is looking at those 4 lockable indexes, all at 25%. That's what the allocation choices would be on the illustration itself and on an application. The moderate strategy is using our 15% multiplier with those same 4 indexes at 25%. And then the aggressive strategy is just somebody using those same 4 indexes, but now using the select bonus. All right, so there's also the 4, 5, and 6 on the right-hand side. Those are the exact same mixes with those 4 different indices, but now they're all at 20%, and you're adding in 20% into the fixed interest account, which is at 5.4%. So it's really just doing that. It's, again, looking at somebody maybe a little more conservative. They absolutely do not ever want to see a zero. So they're going to build in a little bit of a buffer with a 5.4% fixed interest account at 20% of that mix. So that's really, what we've designed. It's built into the software. So when you actually go into our illustration software, there's a little drop down at the very top where you can choose any one of these different options to kind of be your default or to be the illustration allocation options that you're showing to your client. You still have the ability of going in there and manually selecting one or the other, anytime you want. But, the conservative strategy, the number one conservative strategy, using the classic, bonus, and those 4 different indexes, that is actually the defaulted illustration or illustrated allocation options. So if you want to make changes, then you just use that drop down, or you just go in there manually and change up. And here is a closer look at what these have done. So again, this is the number one on that list. This is the conservative, this is the default illustration. You can see the 25% mix in all 4 of the different index lockable options. And it would have done average credit over the last 10 years, it would have been at 11.79. The orange highlights here are showing where it was a 0 at that point. And because of the classic bonus, they're still getting a 1% credit on that policy. All right, the moderate. So now we're looking at somebody using the 15% multiplier and showing that it does a little bit better at 12.126 or 12.26 with the 0% in the blue. So again, where we had the orange in that last one with the 1% in the classic bonus, they would actually return a 0 here when the market was negative. So we do have those added in. We're still getting at 12.26. All right, and then here's the aggressive look. Obviously, the aggressive with that 40% multiplier does give them a higher earning opportunity. You can see that in the average annual interest credited over the last 10 years. However, there are a -1 drag here twice. And then the market was up just a bit, but not a lot. So that's why you're seeing the 0.77 here. So there are some negative returns here, but that still results in a higher interest credit to the client. The one thing to remember is when it comes to the illustration itself, we are not able to show the different multiplier bonus opportunities because of AG 49 regulations. So that's why the default illustration is for the classic bonus. It is the most conservative, and you can see that with the average annual interest credit. It is the most conservative, but it is going to show the best on the illustration because that classic bonus is added in. Even though it's illustrating at 6.72, we're really also being able to show that 1% bonus. So you're really seeing a 7.72% return on an illustration, whereas these, you can't see the impact of the bonus. All right, and then here is that same, kind of looking at adding in that fixed allocation. So now you see everything split across the 20%. You see the numbers come down a little bit, but you also don't see a 0 in any of these years. So this is the way for, those clients that absolutely cannot stomach ever getting a 0. This is how you would want to allocate for them so that they have a consistent return. And even in those negative years, there is at least something being credited to their policy. All right, I'm going to stop again. Is there any questions about these different diversification models that we've incorporated into the software?
No, not right now.
Okay, perfect. All right, so the sales tools. So now we're kind of getting to the end of the presentation here, but the sales tools that we have available. The first two, the backcasting tool and the showcase, these are very important tools to us, but with the scope of the product of getting this launched and getting it launched by 7/16, we are still working on getting those updated, and they should be updated hopefully in the next 30 to 60 days. So the backcasting tool and the showcase. Showcase is one of those where if you are showing a multiplier bonus and you can't really see the impact of it on the illustration, this is a way for you to run a quick report. It's a PDF showing how those bonuses might impact an illustration that's similar to the numbers and values that you're putting into your policy. So we definitely want to get these updated. And again, 30 to 60 days, we'll let you know when those are available. What has been updated is our Insight proposal visualization tool. And Curtis, are you guys using this, or do your agents use the Insight tool?
So we are using that and running that on some of the designs.
Okay.
Not as much as I'd like, though. I do think it's a really neat visual, as opposed to just looking at a standard ledger on an illustration.
Exactly. Yes. So for those of you on the line, how many of your clients want to look at a 50 to 60 page illustration with all kinds of ledgers and numbers? They need to have it, obviously, but you can actually bring it to life by using the Insight proposal visualization tool. It's really just you create it. You create an illustration and then you put it into this tool, and then it automatically puts together a presentation that's visual. So it's digital. You can email it to your client. They can look at it on their phone. They can look at it on their computer or their tablet, whatever they've got there. And they can play with the numbers and look, at some of the different visual things. We have incorporated a brand new marketing story into Insight that is built in, and it also has those diversification models built into it as well for this new product. So definitely take a look at that, Curtis. And if anyone needs help in how to run those, please contact your marketer at IAMS, and they can show you exactly how to build those in, so that you might be able to email those over to your client rather than sending them a 60-page paper illustration. The allocation insights tool, this is really good too. With as many options as we have now, this tool is great at you ask the client a few different questions. What do you think market volatility is going to do? Do you think interest rates are going up or down? All those different things. And then it actually spits out, or it tells you which allocation options might be good for however your client is thinking at that moment that the market's going to be over the next year. So that helps in showing them the different allocation options that are available and what might work for the market scenario that they think is coming. So that's great too. The last marketing materials, you guys, everything's been updated. Everything is on our website now. We do also have a micro site. And if you want to write this down, it's www.allianzlife.com and then /life sales tools. So life sales tools at the end of that with the /. So the reason I bring that up is because all of these pieces are out there, they're available, and you do not need to log into the Allianz Life website to be able to access them. So just want to let you know that they're available either on the website or on our microsite. A lot of them have the different index allocation options that we offer, and it shows charts and those historical values on those as well. So that's a great way to get educated for you and your clients. And then the last thing I want to talk about is transition rules. So we know that there's a ton of Life Pro Plus Advantage applications still pending. They were coming in right up until the 16th. So those applications have the opportunity of switching over to the accumulator product. It's a simple process. All you'll need to do is notify IAMS or the case manager that's working on the policy here at Allianz that you want to switch it. All that's needed at that point is we'll automatically switch it, and then upon delivery of the delivery requirements, we're going to send out a new illustration that needs to be signed, and we're also going to send out an amendment that changes the product to the new product. That's it. So we need 2 additional signatures, all of that only upon delivery. E-sign, however you're signing, electronically or in a paper, person to person, but we'll want that back. That's to change the pending business. If somebody already has a policy that is in force and it's within the free look period, you can also get that switched. I would suggest running a quick illustration to do a comparison. I think you're going to find that the new product is going to show better than the last product. So a lot of our policies are being free looked at this moment if they're within that 30-day free look period. Again, notify the case manager. You'll have to fill out and get signed what's called a service request form or a contract change form indicating that they want to flip it over. And the same thing's going to happen. We will then send out a new delivery requirement with to sign an illustration and also the an amendment to get it switched over. So we wanted to make that process as easy as possible because we know that this new product is going to look a little bit better and be a little bit more competitive. And so we're allowing quick and easy changes to the new product as well. And with that, that's it. So, and then we've got some disclosures to share. So I'll just leave this slide up and see if there's any additional questions.
I'm looking here. I don't see any others that came in here. So I think you covered a lot of good material. I'm going to go ahead and launch our final poll of the day. So obviously we're really excited. We've already started quoting this product here over the last week or so. We're seeing some really good numbers out of it. So if you'd like additional information, like one of the marketers to reach out, go ahead and just check yes on the poll. Outside of that, Krista, really appreciate you taking some time with us today. I know you're on the road this week, so appreciate you taking some time to take a deep dive into this with us.
Absolutely. Thank you so much. And thank you everybody for getting on, and really, thank you for the business and for the opportunity of just sharing the new product with you. And I would invite you all to, go onto the website, run some illustrations. Even if you had an illustration run, just a week ago, maybe get on there and do a new illustration on the new product just to compare where we're at. And we're excited for what's happening here at Allianz and the business that's coming in. So thank you so much.
Perfect. All right. Well, thanks, Krista, and thanks everybody for attending, and hope everybody has a good rest of the day. Thanks.